Welcome everyone to FX Streets. It's 2:06 p.m. Eastern, January 30th, 2013. Welcome back. Great you could join us. My name is Adam Rosen. Very happy to be here. In about 15 minutes time, 2:15 p.m. Eastern, less than 15 minutes, about 9 minutes from now, Federal Reserve, FOMC, Federal Open Market Committee, led by Chairman Ben Bernanke, will release their latest interest rate decision where they are expected to keep rates unchanged at the 0 to 0.25% level. Moreover than that, the Federal Reserve is expected to release a statement that will indicate their opinion as far as where the U.S. economy stands, how long we can expect to have zero interest rates, and the future of monetary policy, specifically regarding quantitative easing. See, and we've discussed this, I know, ad nauseum for the past couple days, weeks, months, even years, but it's worth repeating. We're at 0% interest rates, but that has not been enough to spur any kind of growth in the U.S. economy. So what the Federal Reserve, like many central banks have done, is embarked on a very aggressive round of quantitative easing. That involves the printing of new money, printing new money out of thin air, basically, and using those dollars to buy different assets, long-term treasury bonds, mortgage-backed securities, things of that nature, in the hopes of keeping interest rates, real interest rates, as low as possible, clearing out those very bad mortgages, that toxic debt that's owned by the banks, and in turn create an incentive for investors to take their money out of these low interest-bearing savings account, out of the low-yielding stock bond funds and CDs and everything else, and put that money to work. Because the economy will not recover unless that money is put to work. The economy will not recover if we all stay in gold, keep our money in the savings account or underneath a mattress. By doing so, it actually manufactures inflation, which, is one of the reasons why the stock market's been so strong over the past couple of years. One of the reasons why commodity prices like gold and oil and food have been up so strong. And if you think about it, actually, there's a little bit of a snowball effect, because that inflation not only creates the incentive to put our money to work, but also takes away the incentive to keep our money in the savings account. If we keep our money under the mattress, the same $100 that we put under a mattress 5 years ago is worth a lot less now. It has a lot less buying power. Question is, if the Fed continues this QE, will the markets be happy and the dollar as well? Well, it's a great question. It's all a question of what we expect. Right now the market's expecting, the market's all of us, buyers and sellers alike. The market's expecting that the Federal Reserve will keep interest rates near zero. The market's expecting that we're going to continue to have quantitative easing. What we're looking for today is a little bit more clarification. How much more quantitative easing? I think if the result of today's meeting, to answer your question, if today's meeting we learn that the Federal Reserve is going to keep interest rates as low as possible, quantitative easing will be extended, and maybe even there will be an extra amount of quantitative easing or more quantitative easing for a longer period of time, I think that's going to continue to do what we've known so far. Stocks will go up, commodities will go up, maybe gold will go up, and the dollar will go down. The four charts we're looking at over here are the four different elements of the market. By the way, it's 2:10, so we had about 5 minutes ago. They're not always exactly right on the dot, but they're usually pretty close to 2:15. I'm watching a couple different news feeds here just to see where the news breaks the first. Top left-hand corner, dollar Swissy. Here's a daily chart. Long-term daily chart, zoom out. This is the result of quantitative easing to the dollar. The Federal Reserve prints more money. Each one of our dollars has less buying power. It dilutes the dollar, and the dollar goes down. This is a daily chart, long-term dollar. Top right-hand corner, Dow Jones Industrial Average, daily chart, zooming out as well. This is what quantitative easing has in terms of an effect to the Dow. Dollar's diluted, but there's literally more money out there in the economy. It's not that each one of us has more money, but there's more capital in the economy floating around. More capital to buy iPhones and supermarket things from the supermarket and clothes and cars and homes and everything else. And it's not necessarily that any company is doing a better job at advertising their products and services, but there's just more money out there. So the earnings of each company will go up. Apple Computer's earnings are going up. They're selling a lot of iPhones. But it's also because there's more dollars out there that will buy more iPhones. You know, if you think of the entire U.S. economy, I mean, we're talking about a global economy. Let's talk about the U.S. for a second. Let's say the U.S. economy is represented by the 19 people in this room. And each one of us has $100. Total, there's $1,900 in our universe. The Federal Reserve comes in one day and says, you know what, we're going to help everyone out. Everybody gets an extra $50. Or everybody gets another $10. There's literally more dollars in circulation to afford the same goods and services. Therefore, the earnings of these companies will go up. One of the reasons why stocks go up. Well, on the same note, we take a look at the bottom left-hand corner. That's the euro-yen, which is a great example of the Japanese yen against a currency that has been quite strong. When all of this quantitative easing, and it's not just in the U.S., we have QE in the U.S., UK, Eurozone, Japan, and the different type of stimulus measures, different types of interventionary measures in Switzerland, but nevertheless, global quantitative easing, it creates a seatbelt for us, a higher floor. And, you know, we're all sitting on an elevator, and the elevator keeps on rising. So, as a result, capital tends to move out of the low-yielding yen. Interest rates in the yen are always historically very, very low because they're an export-driven economy. So when we feel like taking risk, you know, the analysts will say risk on. When we feel like taking a risk, we'll buy a higher-yielding currency, or we'll buy a currency with low interest rates that we think have a good chance to raise interest rates. Well, the euro is a great example. But euro-yen rally to the upside, make no mistake, this is not just because the fundamentals in Europe are so great. They're better than they were before. But this is the result of capital moving back into other currencies and out of the yen. It's not that the euro is strong. The euro is strong. But it's more of the fact that the yen is so weak. Bottom right-hand corner, this is gold. Disregard that long candlestick wick. It was some kind of false print on my charts. It's kind of hard to, you know, let's go to like a weekly chart here. Again, that long red, that's a bad tick on my chart. Again, as quantitative easing dilutes the dollar, if we had $100 in our bank account 5 years ago, it's worth a lot less now, even though it's still $100. Therefore, we want to buy something to hedge ourselves against the falling dollar, and the number one choice among traders is gold. As the dollar goes down, gold goes up. Ideally, if we had taken, let's say, 50% of all of our money in cash and converted half of that cash into gold 4 years ago, theoretically, we would have the same buying power now. If we converted all our money into gold, we'd have even more buying power. Because gold, you know, a couple of years ago was $1,000 an ounce and went up to almost $2,000 an ounce, and now we're $1,677 an ounce. If we left all our money in dollars, in cash, we would have had less buying power now. So gold moves in the opposite direction of the dollar. I'm going to switch into 5-minute charts, by the way, because I like to see the immediate market reaction. But again, quantitative easing leads to a weak dollar, strong stocks, strong yen crosses like the euro yen. Whoops. 5-minute euro yen. And strong gold. Now, it's all relative. And by the way, what time is it? It's 2:15 right now. So we're waiting for a piece of news. They're usually right almost on time, 2:15 or so. Looks like something's coming out because I'm seeing the market react. Okay. So let me read from my news tape here. There's a lot coming out. Okay, I'm going to read the highlights from the news tape. Federal Reserve keeps federal funds range unchanged at 0 to 0.25%. Voted 11-1 for Fed funds rate action. Economic activity has paused due to weather and other factors. I'm assuming they're talking about Hurricane Sandy in the Northeast. Unemployment rate remains elevated. Employment continued to expand at a moderate pace. Household spending, business investment advanced. Housing sector shows further improvement. Inflation somewhat below 2%. That's important, by the way. We have to talk about inflation. Inflation somewhat below 2% objective. Expectations stable. Economy to grow at moderate pace with a policy accommodation. Unemployment rate to gradually decline with a policy accommodation. Global financial strains have eased, remain a risk. Fed to continue purchase of $40 billion of agency mortgage-backed securities per month, as well as $45 billion of treasuries per month, continues to reinvest principal payments. Fed to continue securities purchase unless substantial labor market improvement. Will keep Fed funds rate very low as long as unemployment above 6.5%. Highly accommodative stance remains appropriate for some considerable time. Will keep rates very low as long as inflation is seen under 2.5%. Fed will look at other factors beyond inflation, employment, unemployment, etc. FOMC George, I don't know who that is. I guess it's a member that we don't usually talk about. Dissents, concerned with financial imbalance and inflation. Well, I guess that's 11-1. There's a number of Fed presidents, Federal Reserve official. There's one president, that's Bernanke. There's about a number of different officials. One of the officials, by the name of George, he dissented. He said he's concerned with the financial imbalance and inflation. Okay, let's go through this one by one. I'm going to chat all these notes in. Okay. Fed to keep rates unchanged at 0. Okay, 11-1 vote. That's that's important because it shows that, from time to time we have the Federal Reserve officials that will, they'll have a 5-6 vote, 4-7, things of that nature. But they're pretty, except for this Fed official George, they're pretty aligned. Now I think it's customary. In fact, I've heard that it's customary that that the Federal Reserve officials, in the end, they'll fall behind Chairman Ben Bernanke, the president. They will dissent on paper, but at the end of the day, they pretty much tend to fall in line. Now, it is basically the same old thing. I think, and I don't remember what the vote was last time. I don't know how much of a difference that makes. I'm watching all of these charts, by the way, as we speak. A little bit of a movement so far. But it seems that 11-1 vote, they're pretty much aligned as far as which way they're going to go. If the vote was 5-6 or 7-4, 4-7, no, it'd be 7-4. Sorry, in favor of keeping rates unchanged and quantitative easing as is, I would say, well, if conditions start to improve, we might see a change in pace. Think of it, 11 of us are sitting around the table for board of directors meetings and we're running we're running Apple. And 11 of us vote, you know what, we like the iPhone and we like the iPad and that's what we're going to do. And 11-1, well, we're going to continue with the iPhone. But if it's a vote of 5-6 or 7-4 or 5 or something like 7-4, then there's a good chance that maybe if the iPhone doesn't sell so many units next month or next quarter, well, we could seriously consider a change. They seem to be, 11-1 seems to be pretty aligned. The market's relieved. I don't know if they are. I don't know that they are. I'm looking at the 4 charts. We see the dollar's going down. It's a little early to tell for sure, but the dollar's going down. The Dow is going down, the euro-yen is going down, and gold is going up. Well, let's take the dollar and gold first off. And I have a lot more of this Fed statement, so I'm going to jump back and forth here. But let's switch to technical analysis for a minute. This meeting today, the result of this meeting, the Federal Reserve has said, look, things are still bad. We are still going to, continue their foot, all the floor, what's the expression? Gas pedal to the floor. I can't remember what it is now. Full throttle, quantitative easing. That's what I'm trying to say. And that things are really not that good right now. Things are a little bit better. I mean, they said, inflation is somewhat below 2% objective, expectations stable. I mean, they kind of hedged themselves a little bit. What do they say about Europe? No, they say economic activity is paused due to weather and other factors. I don't know what other factors. You have to read the statement and see what it is. And I'm just reading the highlights here on the Dow Jones news tape. Global financial strains, I guess I was interpreting it as Europe. Global financial strains have eased, but remain a risk. But whatever the reason, they're not changing anything. No, there's no change. Well, we know over the long term, quantitative easing tends to lead to a weak dollar. There's a dollar Swissy. This is a daily chart. This is what's happened over the past couple years as a result of quantitative easing. Dollar goes down. I know we had a little bit of a rally here, but now we're going back to the downside. So today's reaction is actually pretty logical in my mind because the Federal Reserve told us nothing new. And the dollar goes down, which it has. The stock market is so gold as a result of quantitative easing goes up. Gold today is going up. Here's a 5-minute chart. Bottom right-hand corner, this is gold. That's going up. That's logical. The stock market's a little bit of a funny animal because the stock market, the dollar and gold are pure financial instruments. The dollar only cares about the future of interest rates. It doesn't care about how we feel about it. And gold is just watching the dollar. The dollar is watching the Fed and gold is watching the dollar. The Fed says nothing new. We're going to have a lot more quantitative easing. We're not out of the woods. The dollar says no problem. We're going down. I don't care. We're going down. Gold says, hey, the dollar's going down. I'm going to go up. I mean, obviously, I'm making a little bit of a joke here. That they don't really talk. It's more that the traders are talking. Now, the Dow Jones Industrial Average, top right-hand corner of the screen. Over the long term, true, it does. The Dow and stock indices tend to go up when we have more quantitative easing. However, the stock market is not a dollar. The stock market is made up, the Dow Jones Industrial Average are the 30 largest companies like Alcoa and American Express and Boeing and Caterpillar and all those other companies. And they're not only concerned about quantitative easing. I mean, once upon a time, before 2008, companies used to make money based on earnings. They used to make money based on selling products and services, and they actually still do. Quantitative easing has helped buffer the shock on the way down. Quantitative easing has created a huge incentive because we can't get anything if we buy a bond these days. And if we put our money in a savings account, we're actually losing money against inflation. So, the Dow has gone up as a result. But the stock market, all these different companies, they're also saying, listen, on one side the Federal Reserve says we're going to get more quantitative easing. But on the other side, the stock market, I'm guessing, is saying, well, wow, things are really not that good because we're getting more quantitative easing. It's a careful push and pull kind of situation. It's imagining with the doctors, and the doctor said, if the Federal Reserve had said, you know what, you don't need any more medicine. I had the flu a couple of weeks ago. You don't need any more medicine. You're getting better. Initially, I might actually feel worse as the doctor takes me off the medicine, but over the long term, that's good news. That's if the Federal Reserve had good news to tell us today. They did not. The Federal Reserve told us today, things are still really bad, so we're going to keep you on the medicine. Now, on the short term, the medicine might feel good, but I think the stock market's starting to think to themselves, you know what? We have customers, or at least we used to have customers. Caterpillar used to sell a lot of tractors, but now they're looking at the Fed meetings, the Fed minutes, and they're saying the Federal Reserve just said unemployment rate remains elevated. That inflation's below the 2% objective. It means you're going to get more medicine, but what I would think would be better news is if we did not need more medicine. As far as the euro-yen, the euro-yen, it's a more pure way to just measure the optimism versus the optimism versus pessimism in the market, the sentiment of the markets. Take away the specific issues about the dollar. What is our opinion about the global economy? If we're optimistic, or if we think we're going to get more quantitative easing, which I think we are, the euro, yen, and Aussie will tend to go up. But the euro, yen, these other yen crosses, they tend to follow the stock market. So in a sense, the dollar and gold tend to watch each other very carefully. The Dow and the euro, yen, and other yen crosses tend to watch each other very carefully. Of course, everybody's watching everybody. Kind of complicated, but fun to watch. All right, so the Fed said they're going to keep rates unchanged at 0. I'm sure I probably did not clear anything up by that. They said unemployment rate remains elevated. In fact, you know what? Let me see if I can get the actual statements. That would be kind of fun. All right, there we go. All right, information received since the first Federal Open Market Committee met in December, this is today obviously, suggests that growth in economic activity paused in recent months in large part because of the weather-related disruptions and other transitory factors. Employment has continued to expand at a moderate pace, but the unemployment rate remains elevated. Household spending, business fixed income advanced, and the housing sector showed further improvement. All of this is important, but it's not what I want to focus in on. This is what I want to talk about. Inflation has been running somewhat below the committee's longer-run objective, apart from the temporary variations that largely reflect fluctuations in energy prices. Longer-term inflation expectations have remained stable. That's the first important point, number one. You see, somebody might think to themselves, well, yeah, quantitative easing. I mean, the Dow Jones Industrial Average are almost at a new high. Why not just leave it on indefinitely? I mean, why not just, go back to the doctor and continue to take more and more medicine? If we literally take medicine every single day, we'll never get sick, right? Well, we can't exactly do that, otherwise we all would do that. The reason being is because there's a negative consequence to quantitative easing. It dilutes the dollar. That's why gasoline was $1.84 5 years ago, and it's now $3, $4, $5 a gallon, depending on where you live. So, and that's why food also in the supermarket has become so expensive, because of quantitative easing. So, and we refer to that as inflation. Now, the Federal Reserve, they're caught in a conundrum. I think they've painted themselves into a corner, literally. They don't want to raise interest rates now because that would slow down the economy, and it's the last thing we need. Our GDP numbers came out earlier today, and we have actually a negative GDP number. The first time it's been negative since 2009, so that's not good as is. The economy is not doing well. Not within a negative 0.1% GDP. The Federal Reserve says, so we are justified to continue to create inflation. Sorry, no pun intended. To continue to create quantitative easing, as long as inflation does not get out of control. In other words, imagine we have the same salary we have now. 3 years from now, the only difference is gasoline is $12 a gallon, and every time we go to the supermarket to buy a little bag of food, it costs us $600. I mean, that's not, all of a sudden, that's the same thing as going to the doctor and taking medicine every single day. Eventually, we'll grow an immunity to the medicine, and then when we get sick, it's going to be that much worse. So, with anything, managing an economy, monetary policy, which is, what the Fed's charged with, it's a careful balancing act. Should we have more quantitative easing? I mean, there's 22 people in the room. I'll ask all of you. Here's our poll for the day. Based on today's data, and remember, GDP today is negative 0.1%. Inflation target is at 2%. We're below that. They want a 2.5% inflation targets. Remember that when they talk about unemployment should be under 6.5%, and where are we still? 7.8%. Based on today's data, what would you recommend? And I'll give you 3 choices here to keep it simple. Okay. Choice number 1 is continue with 0 interest rates and more QE. Don't answer yet. Number 2, take away quantitative easing, meaning no more bond purchases and anything like that. Continue with low rates indefinitely. Definitely. Number 3, these aren't really very well thought out questions here. Number 3 is no more QE, no more, and begin to raise rates along with inflation. Now, when I talk about inflation, I'm not talking about, now you can vote, I'm not talking about what the Federal Reserve calls inflation. When I'm talking about inflation, I want you to think of how much you spend to get gasoline, how much you spend to go to the supermarket. Because the thing is, if the interest rates are then allowed to go up with the price of gasoline, what will happen? Capital will tend to come into this country from other countries because they're going to see that we're going to have higher interest rates. If the interest rates in the U.S. start to go up, along with the price of I'll call it real inflation, okay, then we'll have maybe 2 or 3% interest rates in this country, and then on the same note, Eurozone, people in the Eurozone will start selling the euros and buying the dollar. The euro-dollar short will become a carry trade. And as capital comes into this country, it will invest in U.S. stocks. You see, the economy does not only recover if we hold up the economy ourselves. As our economy improves and we start to raise interest rates, foreign capital, foreign investment, will come into this country, will buy our dollars, buy our real estate and our stocks, make everything that we already own more valuable, and as a result, things will be better. Now, choice number C, it's tough love. Look, I'll give you my answer. Then we'll get back to the statement. I'll give you my answer. My answer would probably be closer to C and I know I didn't give you this choice. It's not fair. But I don't have to play by the rules, right? My choice would be C, but with the proper fiscal policy, meaning low taxes, low regulation, where the economy is actually allowed to expand. We have a very high tax burden right now. We have 39% corporate taxes in the U.S. It's the highest in the world. Japan was number 1. They lowered their rates. Okay? So if we had proper fiscal policy, let's say a 5% corporate tax rate, then Apple Computer would take their 500,000 jobs that are right now overseas and bring them back into the U.S. And they would take their $1 billion that's sitting in cash overseas, and that would bring it back into the U.S. So, as you can see, the answer, it becomes a discussion of fiscal policy as well, not only monetary policy. I think they both go hand in hand. I mean, how do we bake a cake? We need a little bit of sugar, we need a little bit of milk, and a little bit of frosting. Well, I know there's more to it than that. But it's not just one ingredient. We need a lot of different ingredients. We need those ingredients to work well together. The criticism of choice A, continue with zero interest rates and more quantitative easing, is that, well, for the average U.S. consumer, although stocks go up, and although commodity prices go up, if we're not specific, we don't make a specific effort to benefit from that inflation, we're going to lose money. But then again, I guess I could say choice A, I don't like choice A. But if you make the right decisions, choice A could be a good decision. Because if you take all of your money, or not now, but if you had taken all of your money and had the foresight to know, I did not. I had no idea that we were going to run into this QE 1, 2, 3, 4. I had never heard of quantitative easing before all this came along. But if somebody had told us quantitative easing, and it's my own fault, I should have paid attention. After QE 1 and 2, stock market still went up after the fact. If we had gone long gold and stocks and real estate in the right areas, we actually could have outperformed. I mean, you take a look at the Dow Jones Industrial Average. Here's a daily chart. QE1, weekly chart here. Quantitative easing 1 started, I believe it was March of 2000. I forget exactly when. It was right around the bottom, 2009 or so. Of course, there are other factors at work as well. QE2 ended June of 2011. This is when QE2 ended. Whoops, wrong line. Even after QE2, if we decide to buy the stock market 11,000, 12,000, or 13,900, it still goes up. So, I don't know what the right answer is. I think the right answer for us as traders, and thank goodness we're traders, so we don't have to actually make these big decisions like the Federal Reserve does. But as traders, I think it's just important that we recognize the correlations, the cause and effect, the causation of these policies. Let's continue to read their statement, by the way, while we still have some time here. Consistent with its statutory mandate, the Committee seeks to foster maximum employment price stability. The Committee expects that with appropriate policy accommodation, economic growth will proceed at a moderate pace, and unemployment rate will gradually decline. Although strains of global financial markets have eased, the Committee continues to see downside risk to the economic outlook. The Committee also anticipates that inflation over the medium term will likely run at or below 2% objective. I want to know how many people in the Federal Reserve's Committee are filling their own cars up with gasoline, because that does not feel like 2% inflation to me. And gas goes from $1.84 to $5 in 40 years. That's not 2%. To support a stronger economic recovery and help ensure inflation over time is at rate most consistent with its dual mandate. This is what the Committee is going to do. $40 billion of agency mortgage-backed securities, MBS, per month. $45 billion of long-term treasury bonds per month, for a total of $85 billion a month. They're buying long-term treasury bonds that keeps real interest rates as low as possible. That's why we can buy a house with a 30-year fixed loan at almost nothing. And mortgage-backed securities, well, we have all these banks that are saying we don't want to lend anybody any money to buy a house. And a lot of us want to buy a house, but the banks keep on saying no. So the Federal Reserve says, okay, you know what we're going to do? We're going to tell all the banks, package together all your bad debt. Kind of like what started this problem in the beginning. Put all your bad debt together, all your toxic debt, those foreclosed homes, all those unpaid bills. Put them into something called a mortgage-backed security, and we're going to buy it. We're buying away your bad loans from you. Imagine you run a business, you have some customers that pay their bills, and the other customers let their credit cards and their checks bounce. Imagine the federal government were to come along and say, you know what? All those customers who bounced a check, give us all those bad checks. We're going to give you cash. Give us all the bad checks. We'll deal with them. That's what the Federal Reserve is doing. It's unbelievable how, some people would say it's very intrusive, but, that's what they're doing. So again, back to our previous point, if we're a trader and, whether we pick A, B, or C, there's nothing we can do. We're participants in the market. Then Bernanke's in charge. But as a trader, what we can do is position ourselves to protect ourselves from quantitative easing and to position ourselves to benefit from quantitative easing. And this is not new, buying mortgage-backed securities. Take a look at what the stock market, specifically the banks, the big banks, and the housing stocks have done. The big banks, I'm talking about Bank of America, Citigroup, American Express, JP Morgan, Wells Fargo, banks of that nature. The big lenders out there. Take a look at the big home builders, those companies that actually produce homes. Toll Brothers, Lennar, BZH, TOL is Toll Brothers, Lennar's LEN, BZH, Hovnanian is HOV, KBH is another one. I used to know them all. Anyway, those stocks have been very, very strong in the year 2012. I would not be surprised. They're all near 52-week highs. I don't know with the stock market at such lofty levels if they'll continue now, but the trend is your friend, and the trend is up in those housing stocks and in those banking stocks. The banks are issuing mortgages, and the Federal Reserve is taking the bad mortgages away from them. The housing stocks are doing well because more people are buying home or building homes because, the banks are able to lend more money. So even though things are still quite bleak, things are getting better in terms of the banks and housing. Now, if things are getting better, how come GDP today was negative for the first time in 2009? Because we're talking about very specific sectors. If you take a look, and that's what's really, on one side it's disturbing, but on the other side it's unbelievably exciting as far as the economic situation we're in right now, because the economy is the economy, and everything kind of goes up and down together. In the year 2000, in the late 90s, the tech stocks went up, and the banks also went up, and the housing stock, everything went up together. And then when the crash in '01, everything went down. But now we have a very sector-driven economy. If you don't believe me, take a look at the coal stocks. We had EPA regulation that basically destroyed the coal industry, whereas you had the Federal Reserve buying mortgage-backed securities, which sent stocks, housing stocks, and banking stocks at 52-week highs. It's a stock picker's market, and I think it'll continue to be that case. You have to see which direction the Federal Reserve wants to be friends. If the Federal Reserve wants to be friends with housing stocks and banking stocks, I would be friends with those stocks. Stay away from those companies that have, a increased amount of regulation. But back to the Forex markets, what can we expect? It's after talking about the stock market, it's actually kind of an easy thing to do. In terms of the Forex market, as far as the dollar is concerned, I continue to expect more weakness. I'd love to say something new, but, there's more quantitative easing. Now, the Federal Reserve has given us really specific very specific parameters. 2.5% inflation, 6.5% unemployment, and as far as GDP, I think they have, I'm guessing here, I think it's a 3% target. But today's GDP was negative, so we're not even going in the right direction. If you really want to dissect it and be a macro manager, take a look to see what the Federal Reserve is talking about in terms of the why was the GDP number so bad this morning. They attribute to weather. Hurricane Sandy, a lot of destruction, a lot of businesses were not able to stay open. A lot of homes were destroyed. Let's see how fast the recovery is. I know the Congress just passed, like a $50 billion aid package and another multi-billion-dollar aid package. Let's see how fast. Let's see how many homes are rebuilt and how soon that construction starts. Maybe that'll be the determining factor, but I find it hard to believe that one little area in the country is going to determine the entire GDP. The GDP number was negative this morning because the entire country was negative. Question, Treasury bills will be weak too? Well, again, they're buying $45 billion of long-term treasuries every month. When you buy the bond goes up, the yield goes down. So I would expect the yields to stay low. I don't know how much lower they're going to go, but I would expect the bonds to stay strong. Again, I don't think it's a good investment because they're already very, very high, and you're getting almost nothing. I mean, you're buying something at a 50-year high that pays a 2% yield. It's not, I would rather look to position myself that still has some room to grow. But yeah, I mean, based on today's statement, there's no reason for me to believe. You have to talk to a real bond guy. I used to trade bonds, but many, many years ago, and there's a lot of nuances as far as the medium-term, short and long-term bonds and maturities. Also, there's always that looming threat of maybe some kind of downgrade. Some analysts are predicting the bond bubble breaking and yields going up. Again, that would be, you read my mind, that would be the case if we have another downgrade, like Standard & Poor's downgrade our credit rating last time. But that means that the entire perception of our economy has to change. Even though Standard & Poor's, S&P downgraded the U.S. credit rating August of 2011, which led to the stock market going down, I'll tell you the trade that I took that day. I shorted bonds. I was long the yield. I had never imagined a day that the U.S. credit rating would be downgraded. But at the time, I was looking at my terminal, and I was looking at the Spanish bond yields and the Italian bond yields and the Greek bond yields, and I'm saying to myself, wow, the first time in more than 100 years U.S. credit rating goes down, I have to imagine the yield's going to go up. Maybe the world's going to look at us as being a little bit more of a risky bet. But the world had more faith in the U.S. economy than I did. The yields actually went down. It was amazing. Credit rating downgrade and the yields went down. Why? Because the stock market went down. Yields decided to follow the stock market and not the gut reaction fear. I lost money in that trade because I was long the yield. I was short bonds. So, yeah, there is a bond bubble, I agree. And it wasn't a lot of money. And yields eventually will go up, but I think it's going to occur with a major change, major paradigm change in what we're looking for. Don't trade like me. I've been trading, betting on, that major trend to change. The trend is your friend. It's there for a reason. The dollar continues to go down for a reason. The Dow Jones Industrial Average continues to go up for a reason. It's fun to theoretically say, well, this could be the top, or that could be the top, or that could be the top. But how much money would we have wasted selling short the tops, only to see the market go up more, as opposed to if we had bought the bottoms here, 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 here. I mean, the trend line's going up. Why not just go with the trend? As they say, the trend is your friend. Okay, so let's see if there's anything important I can pull away from the statement while we have a few minutes left here. Great questions, though. Committee will also closely monitor incoming information, economic and financial developments in coming months. If the outlook for the labor market does not improve substantially, the committee will continue its purchases of Treasury and agency-backed securities, employ its other policy tools as appropriate until such improvements achieved in the context of price stability. I know it's not the easiest language, but it's amazing. The Federal Reserve is telling us exactly what they're going to do. It's not like we're surprised by any of this. In determining the size, pace, and composition of its asset purchases, the committee will, as always, take appropriate account of the likely efficacy and costs of such purchases. I think they're talking about the unintended consequences of inflation. So things are going to continue to be difficult, I think. But if things get really, really more difficult, then maybe we'll see more of an Operation Twist and less quantitative easing. The difference is Operation Twist, we don't manufacture new money. We sell short-term bonds, and we take the proceeds of those short-term bonds to buy long-term bonds. It accomplishes the same thing of keeping interest rates low, but it's not as aggressive, and it doesn't create as much inflation. How might Europe react to this in addition to London? We're all sharing a global economy. The Eurozone has their own version of quantitative easing in the form of purchases of bonds for a different reason, because bond yields were through the roof in Greece. I mean, 27%, I think, at one point, maybe higher. Italian and Spanish bond yields had crossed above 7%. In that case, it did reflect fear, uncertainty, creditworthiness. But global quantitative easing tends to make everybody feel better. It's like we're all kind of taking medicine together. We're all taking painkillers together. That's really the quantitative easing is not medicine, it's painkillers. So I think it's going to, to answer your question, I think the euro-yen has a good chance to continue to go up. Now, again, let's look at the chart. I'm hedging my statements because theoretically, this is the euro-yen. Can make a joke, this is a euro-yen and this is a euro-yen of quantitative easing. This is a euro-yen on painkillers. This is monetary policy. This is quantitative easing. We expect more of the same to happen. I hesitate, though, because you look to see how far we've gone up, how fast. I mean, these are normal market trends. Up a little, down a little, up a little, range bound. All of a sudden, the euro-yen, November, in the past couple of months, has gone from 100 to 123. We're talking about 2,000 pips in a couple months here. That's not normal. That's a very hyperactive type of market. So the trend is your friend. I would still definitely, I think the odds are that we go up. But be careful. Make sure you have your stop orders in there. If you're a day trader, my day trades are going to continue to bet in favor of this long-term trend. Where you buy, where you place your stops and limits, that's up to the trader. But the direction, I'm trading with a trend. As far as a long-term trade is concerned, though, maybe if we pull back to support, we could find a nice entry and place your stop orders a little bit below support, and hopefully the trend won't end when we finally decide to get in. Kind of manage a trade like that, with the red line being the stop order. But with the RSI above 70 for so long, we've accomplished really, really big moves. Let's take away all these lines for a second, just to show you what I mean. This is a weekly chart. The RSI on a weekly chart is above 70 for the first time. Let's look. If you don't believe me, take a look at the level of the RSI on a weekly chart. This is how extended we are. The last time the euro-yen was this extended, you ready for this? December 2006. That's how fast we've gone up and how much we've gone up. December 2006. Erase the last 5-6 years. That's how much the euro-yen has gone up over the past year. So I'm very hesitant on saying, yeah, I think the euro-yen is going to go up. I would not be surprised if it does. I mean, 2,000 pips. Who's to say it does not go up another 100 or another 1,000 or whatever? But please be aware. And also, take a look at this double top. Over here. That's kind of scary. Take a look at the high going back to April of 2011. So, I don't know. We could also draw Fibonacci's and look at that. Almost exactly at the 38.2% Fibonacci retracement level. I didn't start this webinar with the intention of trying to pick tops and bottoms here. But, it's pretty incredible the levels that we've reached. At any rate, here's the link for that monetary policy statement. It's on the Federal Reserve website. It's really fun stuff. Go through it because the answer really lies in here. We get these daily numbers, these economic numbers. It's kind of boring stuff. But you take what the Federal Reserve tells us that they're watching and then overlay that on the daily economic calendar. And it gives us a pretty good chance to anticipate which way the market's going to go. Unfortunately, I'm out of time. If you have any questions, you can contact me directly, www.forexlounge.com. I want to thank you very much for joining us. Please see FX Street's calendar. We have so much more to talk about. We thank you for joining us. We wish you a great day, all profitable trades, and we look forward to seeing you back soon. Back inside FX Street.